Hi guys, welcome back to ValeTalks by Valetax. Welcome and happy Monday, happy new month. This is the first Monday in the month of March, and I am willfully and happily excited to welcome you into this new month in the financial market, and overall happy to wish you a new month. Well, today we're going to be talking about a few things that somehow, unintendedly has kind of correlated with the current happenings in the world and in the financial markets. Overall, we see the rise of geopolitical tensions currently happening between the US and Iran. And for some reasons, today our topic is going to be on understanding market directions and macro trends. And this is episode 12 of ValeTalks. Hi, my name is Rion Ifere, and I'm going to be your host for today. But before we talk about myself, let's quickly dive into my guest for today, Manesh Patel. Hi, Manesh. Welcome to ValeTalks.
How you doing?
Very
happy
much
March.
fine. As always, happy March to you too. It's always a pleasure having you around. So Manesh is a global market strategist and an educator, an engineer with a CMT and CFT certification with over 25 years of experience in the trading world. He is the person who worked and developed the black box with institutional firms and the author of Trading with Ichimoku Clouds. Unfortunately, Kaza wouldn't be joining us today due to unforeseen circumstances, but he'll be joining us in the next meeting. And I am your host for today, Rion Ifere. I'm a senior global market analyst at Valetax, and I have over 6 years of trading experience in the market, and I'm the founder of the Rion FX swing trading community. Thank you guys for joining, and if this is the first time you're on Valetax, I hope you sit back and enjoy the session. Okay, moving on for today, this is our overview for ValeTalks today. We're going to be looking at the big picture, which is who really drives the market and what really drives the market. Then number two, we're going to understand why macro sets the direction, because a lot of people think technical analysis just moves the market. But as a matter of fact, technical analysis is just a footprint of what the market as a whole in general is setting course for. And number three, we're going to try and understand what is the responsibility of the trader when macro sets the trend and when chart starts to print out the direction for the market. Okay, so as always, I like to start off first with the definition of what macro trends are. As you can see on my screen here is macro trends are long-term market directions driven by economic forces, policy decisions, and global developments that influence capital flow across currencies, commodities, and indices. So when you think macro trends, sometimes people don't understand where we say fundamentals. When we talk about fundamentals in the financial markets, we're basically referring to macroeconomics and macro trends. So we're looking at policy formulations by Federal Reserves, central banks. We're looking at fiscal policies that directly affect, monetary decisions in a country. We're also looking at geopolitical events, the tensions. We're looking at pandemics. All of these things affect capital flow because at the end of the day, the financial market is a base of investors, governments, multinational, transnational, and then retail traders. So moving on, let's get into the topic for today, discussing with Manesh. As always, hi Manesh, how are you doing and how's your March starting?
It's good. Happy Friday trading for March, beginning of the month of volatility.
There's lots of volatility currently happening in the market, and we're going to get right into that. But first, let's talk about big picture drivers, okay? We know that market follows money, and money follows macro, because at the end of the day, the liquidity in the market isn't that of retailers only. It's a lot of, bank, hedge funds, institutions, countries, and big economies especially. Now, we know these macros to be economic data, central bank policy decisions, inflation and interest rate and geopolitical developments, war, crisis, conflicts, economic disputes, and all of these things entirely. But with all these things being said, trying to understand the macros, I know you're not a high fundamental trader. You're very technical, and you try to understand where the money is going to based off the charts. Why is it important, regardless, that macro trends are understood even lightly for traders, especially in the retail world?
I think on the previous slide, you had it perfectly. Macro trends, macros set trends, right?
Yeah.
So the goal is long-term trends, not short-term, because that's where all the money is. That's where all the money is flowing and stuff like that. So the key is looking, you don't necessarily have to understand the macro trends. I don't. I know there's a central bank decisions on interest rates, and there's unemployment numbers and CDP, CPI, and all this data that keeps on coming out. But for me, I don't understand all the reports and I really don't want to get involved with all that stuff. But what I look at is to see what these macros are doing to the charts. Are they, what type of trend are they setting? If they're setting a long-term bullish trend, then you know the markets are bullish for that particular product. If it's bearish, it's bearish. If it's consolidating, then it's just going back and forth. So these macros are the catalyst to start the trends. So I do pay attention to them indirectly, not directly, right? So I'm not looking at things on a smaller picture at all. So when reports come out, I look to see what the long-term trend is based on the entire picture of the macro for that particular country, particular product. And then the small reports come out. If it's against the big picture, then, you know, I'm looking for it to kind of go against the major trend and waiting patiently for it to come back to the major trend. Or I see if it's going to shift the big picture or not. So I look at the reports and see, is it going to follow the big trend or is it going to go against the big trend? And then based on that, you can make trading decisions. But overall, you know, it's you know, it's there and it starts the trends. It's the catalyst. Without that, you really don't have a big catalyst at all to start major trends. So they are very important to everything that's going on.
Very true. I just saw a question here and on the live, and someone asked, he said, with global tensions escalating in the Middle East, what are the real impacts traders should be watching in the market? So when the issues of war or global tensions, you know, like there's war crisis, some of the major things you need to understand is investors and, you know, capital flow starts to rebalance itself. So you hear people saying things like, oh, you know, liquidity is relocating from different assets into other assets. It's the first things first any smart investor is going to try to do in a situation like this is protect his investment. Try to make sure that he doesn't lose so much of his portfolio. So in terms of crisis, the first thing, you know, traders should look out for is what are going to be the risk of, you know, assets or commodities or pairs, and where would a bulk of the, you know, capital be moving into or be flowing into. So safe havens is the number one thing, you know, you need to be looking out for, you need to pay attention to. Number two is you need to understand what the risk ons are. What economies have a very, you know, stable economic system or stable banks, comfortable interest rates, because investors wouldn't put money where they're not getting anything back, but they also want to put their money where it's going to be safe. So you're going to look at what are the, you know, current risk on pairs. Then you need to understand what exactly is the war about and what countries is it affecting. What are this crisis affecting? So now we're seeing the crisis between US and Iran. We understand that the Middle East is the channel pathway for a lot of oil when it comes to, you know, when it comes to oil in the world. Yeah. So we see the Strait of Hormuz right now, you know, that, you know, channels about 20 to 30% of the total supply and movement of oil in the world getting blocked out. So that tells you that something is going to be up with oil. Now, the way to see it is it doesn't automatically crash the prices of oil. So there's a misconception the retail traders don't understand about the market is when something bad is happening, you need to understand what is it affecting. Is it affecting demand or is it affecting supply? So you first need to understand where exactly on the scale you're on. So if we get a blockage, of, you know, the movement of crude oil through this passage, it means it's going to be affecting supply. So what is the counter of anything affecting supply? Meaning that since people already know that this would affect supply, they're going to be pricing in on whatever the price they can get their hands on so they can have more in storage. So demand increases. So that is the gap that you need to understand. If it's affecting supply, demand increases. If it's affecting demand, supply increases. So that's just a tip for you. So what you need to be looking out for in the market now is not trying to jump into the market aggressively, but trying to understand and follow the trend. So what is happening and how does it affect whatever asset or commodity you're going to be trading? That's why it's important for you to, listen to the news. You should probably be on Bloomberg, CNBC, and all of this, macro news channels. They kind of help you because you listen to analysts, you listen to people who are macro experts talk about these things, and they kind of give you an idea. And remember, they are never financial advice. They are just, ideas and analysis for you to follow. So financial advice would be more like telling you buy at this point and take out at that point. So it never comes that way, okay? So you need to pay attention to that. And we're also going to be talking about similar things on this call towards the middle of the call. So towards the middle of the live rather. So make sure that you're seated and you're following. Okay. So yeah, Manesh, we were talking about how it is important, regardless of how you view the market, for instance. And you said something very important to you. You're not trying to follow every macro data, but you're trying to understand what the bigger picture sets in. And I think people need to understand the correlation between every macro data. So these, when I call them macro data, I personally like to refer to them as indicators, economic indicators, yeah? So there is a correlation between CPI, PPI, PMI, PMI, ISM. Then you also have the correlation between CPI, job reports, unemployment claims, unemployment rates. So they're not individually scattered because sometimes a lot of retail traders just trade the release of one. So what they do, basically, they just react to the short-term effect on currency, not the economy. So yeah. I would always teach my community and I'll tell them, I say, macro releases are not what you trade right now. They are what you understand to price into the market. So we had a quick chat just right now when I was telling you of possible rate cuts for the pound, and then we're seeing high interest rate hikes for the yen, bringing in straight into the yen. And when you look at the JPYX, the Japanese index, you can also see the pricing from the demand level where it currently is at technically. So you have like now that you like to go with the bigger picture. So when you look at the JPYX, you can see that price that is at the demand and has started to create series of higher lows to the upside, even though it's ranging a bit. Now, I can also look at currently the geopolitical tensions in the world right now, and understanding that JPY is a very good risk on pair. So we would see a lot of fall-offs and sell-offs into the JPY because they have a more stable interest rate. It's a better cash reserve right now, not an asset for a lot of investors. So things like this now can help me have an understanding of where I should be positioning myself. Doesn't necessarily mean it's giving me an entry immediately, but long-term, I have an idea of where prices are going to or would be going to. So by the time you get an interest rate cut by the Bank of England, and then you get an interest rate hike from the Bank of Japan at the end of the month, now you have more confluence to the direction of the new trend. Or if you do not get it, then you know that the old trend still plays out. So you know how to position yourself. But what a lot of retail traders do is they are so focused on just the numbers. So I hear people always being happy saying, oh, CPI numbers, were higher than expected, so it's good for currency. And I'm always smiling and I'm like, do you really think CPI is what the US government wants to be high at this point in time? So higher CPI, lower earnings, bad for the economy. Because if consumer pricing, if consumers can't afford the normal things they usually could afford, and their earnings are not meeting up to that inflation, it's bad. So those are some of the things that the reserve banks or the CBN are going to be looking at and be like, oh, this isn't adding up. We probably need to inflate the currency a little bit. So it leads you to something else overall. So I think one of the major things that retail traders need to understand is first understand the core value or fundamental of an indicator before you then trade it, except you're trying to be a scalper. Because that's what most times you see people run into the market and then it's just one huge spike and it returns and sweeps them completely out of the market. I think I shot a reel about that this weekend that will be posted. So it's mostly just liquidity traps because the currency doesn't dictate the economy. The economy actually decides the flow of the currency. So I think that's one thing that they need to place their mind to. What do you think?
You know what I mean? This world has changed a lot. Looking at reports, it's all because of the internet, right? So, before the internet, you had the numbers, people look at the numbers, and based on the numbers, they react. Yeah. Now what happens? People are forecasting. So like you said, Japan, pound's looking to lower the rates, yen's looking to increase rates, blah, blah, blah. And now that you're making assumptions, what's happening is that you're going in and looking for that pair to move before the announcement even happens. Yeah. Right. And then you have a lot of things now, a lot of revisions are happening with a lot of reports that wasn't happening before. Yeah. So, when you look at these reports and say this is the increase, well, you're comparing it to the last report, but the last report revision, it may not look like an increase. So there's all kinds of stuff that's going on now that, people are forecasting, predicting things before they happen. So when the report does come out, you may not get that reaction that you're looking for because it's already happened. Yeah. So there's all kinds of things that are happening there. You just got to pay attention and understand the big higher picture that's going on. But you're completely correct. You have to be careful looking at all these numbers and reacting to them because you get one reaction and then you'll get another reaction later. And the U.S. is a perfect example of interest rates, cuts, and decisions. So when the Fed comes out and makes a decision on Wednesday, or my 2 p.m. Eastern Standard Time, you get one reaction, and you get that reaction to market close for the U.S. stock. Then, believe it or not, the next day, the U.S. stock market goes completely opposite. Yeah. And you typically have seen that over and over and over. So you have to be very careful with the reactions of all the numbers and everything because it's a matter of interpretation, facts and everything there and the numbers. So this is where you have to know what the natural trend is and focus on that and see if the numbers support the long-term trend or not. If not, you have to be patient and wait for the charts to align back to the big trend. If they're not, and if they are, then you're ready to go. But this is where you have to stay focused. You have to know beforehand what your trend is, what you're doing, and everything, and then wait to see what happens with the numbers. At least very much true. My perspective, right, on trading the numbers. But like I said, I'm not a fundamental trader for that reason because when you go through all those reports, my head gets dizzy. Yeah. Because that's every country has all those statistics, and then you have revision, then you have expectations, then you have the minutes that come out, then people read the minutes, then they interpret it, and so forth. So it's just wow, I get dizzy.
Well, honestly, I kind of understand why we find a lot of traders teach other traders to trade technical analysis. So fundamental analysis is quite broad. And personally, if you had no background in economics, probably while you were in school or probably high school, or pre-degree, or any of those things, if you have no idea or no understanding in basic economics, it might be a little bit difficult for you to comprehend at first. And because it would be unwise for you to try jumping into just every report you see, just because report stations tell you a higher reading is good for currency, but they don't really explain to you the impact it has on the market. That's why you see, so I'm in Nigeria, yeah, and we could get the non-farm payroll at 2:30 p.m. my time, which is 8:30 a.m. Eastern Standard Time, yeah, and prices would run to a direction, and just before the New York Stock Exchange opened, prices have turned the other direction. So sometimes these news reports are just for liquidity grabs. They don't change the trend. They just pick previous resting positions and then use them to actually fuel prices in the direction of the market. And what I came to study over time is, if, for instance, NFP numbers are good, and down this is a big tip for everyone watching the live. If NFP numbers are good but unemployment rate is bad, there's a problem, because it's diverging at that point. You can have good job reports and higher unemployment rates. It doesn't make sense, but people don't understand that. That creates chaos and confusion even for the policymakers, because now you're trying to balance it up. Okay, how's this happening? What's wrong? What sector exactly is causing the unemployment rate statistics to be high, and yet we're still getting good reports on the non-farm job employment? Yeah, so things like that, and then you then have to look at the average hourly earnings. If average hourly earnings is good, if you have a higher job report, if you have a lowered unemployment rate, now that's very bullish for the USD. You're certain that this is very bullish for the USD, especially if you were already on a bullish trend or in a buy structure. That gives you more confirmation to continue the buy structure. But then if you're already on a bearish structure, a heavy bearish structure, NFP isn't enough macro, report to change structure. It can't change structure long term. So you're probably just going to get like a shift in structure probably on the lower time frames, the 1 hourly, 30 minutes, just for that day. But overall, when you go back to the charts to study it, you would see that the NFP report only pushed prices for a deeper correction and the trend returns. So if you're stuck on that move just because you're trying to gauge the market off the NFP reports being good for the dollar, then you've put yourself in a position to, encounter a huge loss or manipulate your own self. And then you hear a lot of retail traders saying, oh, they manipulated the market. No, you just didn't follow what was right. Do you get?
Yeah. And the number one mistake they make, Ryan, is that you're looking at the picture from a long-term perspective, the higher time frame. A lot of people look at reports and look at the 1 hour, 5 minutes, 10 minutes, and judging the report based on the lower. And that can't happen. They have to look at the weekly and see how the report affects the weekly time frame. And then they could really see what's going on. But you looking at a 1 hour and see how the report affects the 1 hour, you're going to get in a knee-jerk reaction where he's going to go one way in the 1 minute, next way. So you really need to look at the higher time frame, specifically like a daily and weekly, when these reports come out, and see what happens in those time frames and how it influences it. And then you can make a decision. But if 1 hour and lower time frames, it really doesn't do justice looking at these reports.
Sorry, I had to step in to get my laptop plugged in. I had no idea it was running low. Okay, so let's move into. Can you confirm you can hear me? Can you hear me clearly?
Yes. Perfect.
Okay, so one thing I also want to just say quickly is macro trends are beautiful, very much beautiful, and I wouldn't in any way ask anyone not to. In fact, I'm a big advocate for understanding fundamentals, because I believe the market is priced off macro. not technical analysis. But it's important that it has to be studied over time. Don't just go take a crash course in a week and think all of a sudden you understand fundamentals. That would be you lying to yourself. Yeah.
Right.
So so let's move. Let's do a quick check in on why macro sets the direction. I think we've spoken so much and we kind of have touched some of this. But first thing we need to understand is policy is the bedrock for literally almost everything in life. So when we're talking about governance, when we're talking about management, policy formation and implementation is the core duty of any management. So the Feds, central banks, why I like to say add central banks, just in case you're wondering if there's a difference between Feds and central bank, is because the European Union calls theirs a central bank. Africa use central banks. I think just the US, refer to theirs as the Federal Reserve. Yeah. So a lot of countries use central banks. So that's why I like to say Feds and central banks. So they are responsible for monetary policy formation, and whatever policies they have formulated and they're trying to implement really shapes the behavior of their economy on a large scale. Then we have the fiscal policy by the government and how they blend together. And that is also one of the things that, propels advancement, progress in an economy or regression. So when we see in, I think in 2022, when we saw the United States at the brink of a recession, we saw how fiscal policy came to balance things in to kind of like hold, things together. And then we saw the role of the Feds played. But why I'm saying this now is macro sets direction, but it's the policy itself that shapes the behavior of the market. So higher rates would attract capital. So when you hear, so this is for the viewers, yeah? When you hear the central bank talk about hiking interest rate, it's because they know the currency is suffering. And when the currency doesn't seem to be attractive to investors, the one thing investors love is interest rates. They're trying to get to know, what am I getting back on my money? When a country has high inflation and they have poor debt management, they're trying to get people to buy off into their debts so they could manage their economy if they can't have an offset of printing in currency. So instead of printing more currency, which is just going to cause monetary inflation at that point in time, they're going to look for you to buy in more debts and things like that. And the only thing that would interest them is interest rate. So when the bank think of interest rate, they're thinking of inviting more people into the market. Now, inflation changes purchasing power. Obviously, it's why we love gold. Yeah, we say gold is a safe haven, not just a safe haven, but it's a hedge against inflation. And some people don't understand that is because every time the prices of gold rises and it gets to a price range, whatever the amount of gold could buy for you in, let's say 10 years ago, it would still be able to afford it in 10 years time to come. So you could see the price of gold move rapidly from 2023, ending of 2023, we were roughly playing around 2,450 on the XAUSD 2024, and now we've gotten to about 5,400. Now, when you go back and you try to understand what happened in 2022, 2023, 2024, you'd notice that the whole world was going through a rise in global inflation. It wasn't just the US. It was the European Union, it was the US, it was Africa. In Nigeria, at 2022, we were up 39% in inflation rate. That was how bad our inflation was. So you could tell the whole world was, trying to manage inflation. And gold kind of caught up. So now if you had, bulk up, saved up in safe havens, your purchasing power still holds value to a large extent, right? Now, central banks don't shift sentiment. So if Manesh was long on the loonie, for instance, and he gets reports from the central bank, he's thinking now, I was bullish last week. as a result of stable interest rates. And the central bank governor just comes out and, he's talking about how he wants to go, hawkish, and he's trying to control, inflation and everything. Now Manesh knows that, okay, so if I was bearish last week, I should start to pay attention to structure shifting, because sentiment overall, based off the policy, statement of the central bank, is already giving me insights to understanding that the market is going to be changing very soon. So I should be placing myself, or if you've been in the trade, probably positioned yourself long term, maybe a swing trade or so. Now you're trying to remind yourself that, okay, I should pay attention to the charts too as well. The moment I start to see sentiment shifting on the charts too as well, that's my profit. That's my profit taking signal. I should be out of this market as soon as possible. I'm guessing that's how you use the the larger macro frame. Yeah, basically off the policy statement, not just the numbers, because the policy statement, I believe, carries more weight, and they kind of project and tell you where they're heading to the next quarter, so you have an idea. And then risk events move money into safe haven. This I stated from the start of the call. So we're looking at gold majorly. Yeah, is the major safe haven. Then we have, like I said, currencies, stable currencies that would act as risk ons for risk off. So JPYs, we have CHFs too as well, that people don't usually talk about that much, but CHFs are also very good, stable currencies to also look at. So that is how macro really sets direction and how policy shapes the behavior of the chart. So Manesh, coming back to you, that is like, your, should I say, I wouldn't take you to be a pure technical trader, because you understand the market. Yeah, you might not play around the macros, but fundamentals, when it comes to fundamentals, it isn't just about the the macro indicators. It's your ability to review, read the room, understand the sentiment surrounding the market, and you have that knowledge. You've worked in the institutional world. You've experienced a couple of black swan events. You've experienced like way more worse things than the black swan events, the COVID-19 and all of these things. How does that really factor into pricing on the charts? And do you think institutions move pricing on their charts? Because retail traders have this belief that institutions are the ones always moving the market. Are they really the ones moving the market, or do retailers themselves actually panic crash the market?
Well, I mean, let's look at the last part. So retail people have a lot more power now compared to what they were before, because a lot of people are trading online and everything. So, before it was institutional money that was moving things. Now you have a combination between institutional, black boxes, automated systems, and then the retail, right? So there's the retail has a lot more power now compared to what it was before. When I understand the macros and all that from a high level. The key is to look to see what they're doing on the weekly time frame. So when a report comes out, I don't know the details of the report and really don't care. I'm looking at the action on the chart. If I see a break of support resistance, now I'm paying attention. Okay, because trading is all about trading around major support resistances. And so if you're at a major support resistance and you break it, then the question is, did it break it or not? If it broke it, now you know which way it's going. If it didn't, you know which way it's going the opposite, right? And I can show you later with, whether it be a macro event or global event, we could look at everything that's going on with Iran. We could look at crude oil and we could look at the picture there, and I could show exactly what I mean by that is, a lot of people are forecasting here in the US and social media that with everything going on in the Gulf, crude oil's going to 100. It just was not realistic at all. And you could see that from the charts. So you get an initial reaction, and then the question is, does that reaction break a support resistance? If it does, or holds it, or gets to a level, now there's a trading opportunity there. If it's not at a support resistance level or breaking it, then it's just pretty much consolidating. It's back to normal what it is. So, I can show you easily with a chart. I'm not sure you want to do that now or a little later, and then we could go from there.
No, sure. Please show me on the chart. Yeah. So let's just do that now, because we're trying to be in line with time too as well.
Okay. So can you see my chart?
Yeah, definitely. Sure.
Okay, so this is crude oil here. This is weekly time frame. As we talked about these macro events that happen, the global events that happen, I treat them both the same way. I look at the weekly time frame and see what happens. Do the events get us to go to a major support resistance level? And then if we do, what happens there? So if you look here, we gapped up to here with crude oil. And if you look back here, this is a major level here, okay? And you could just look at this on the weekly time frame here, and you could see that we've been pretty much at this level here over and over and over and over and over, okay? So this was a major level here at 81.81, and we just happened to gap up to that level. We went a couple of points above it, but that's the major resistance level there. So if this is go up, this has to break that level. Instead, what it did was it went up above it, then came here, and then started coming down. And you could see down the lower time frames that it was holding that level. So this resistance level is holding. So this idea that crude oil is going 100 is just absurd, because you haven't even broken this level here at all. And if you look at it, we're holding that level here, right? So it's still bullish, but you have not broken this level here. And if you were bullish, it was a good idea to take profits at this level here and then wait and see what happens. And that's exactly what happened, because if you look here, this week here, which is February 16, we closed above the weekly high. So this was bullish. Then we got another week here where we closed above the weekly high. So this was telling us from February 16 on that crude oil now is trying to go up and had a high probability to come back and retest this high here, which has been holding here. So, we were bullish on crude oil going into everything. We didn't know the event was going to happen at all. But when this happened here, we gapped up to here, went above it. We were still in a position. The moment it started coming down, we took profits and got out, right? But this is where you have to keep things focused on higher time frames, specifically the weekly, when you get these reports and everything there. And if you look here, before the war happened, or whatever the event happened in Iran, this was bullish. It was giving you signs of bullish, so you stay focused on that, right? If you look at, you were talking about the pound yen, right? With currencies. So if you look here, you have one big red bar, but overall the trend is still bullish here, okay? So until this bullish trend is broken, you really have to keep on thinking bullish. So if you're looking for the reports to change direction, then you really need to see a support broken. So this is bullish until proven otherwise. And the otherwise is that if a report comes out and you break a support and close below it and then follow through, now the direction's changed. But until then, this is still bullish. Does that make sense?
Yeah, that makes sense.
And you could look at it here and say, okay, you know what? Here's the support right here. This is the point of breaking. So this is the last area where it went down, balanced out here, and you could tell this is a major support here. So you could say in your mind, with all the macro events here, I'm still going to be bullish no matter what the reports say until I break this level. If I close below this level with a report, now things have shifted and shifted long-term to a point that report has told me that things are going to be different, right? But until then, I'm still going to be thinking bullish. So if a report comes out and it brings me down, but not breaking this level here, I'm still going to look for bullish opportunities. The report just helped me get a good trade with good reward risk ratio in going bullish, right?
So so looking at that bearish candle that formed on the GBP JPY, yeah?
Yep.
Where was the candle coming from? Isn't that a very key resistance too as well when you look at the monthly?
Yep. So this bar right here.
Yeah.
So if you go to the monthly and you look at the monthly here, you could see there's a level right here that it came to. This is the level, this was the resistance here. We broke it, retested it here. So this is still bullish. Even though that bearish candle came in, this is still bullish.
Okay.
So this is a buying opportunity for a lot of people. And one candle does not make everything at all. So whatever causes here a report or anything to come down, as long as you're focused on what the long-term picture is, which is bullish, you would still, when this happened here, you would still look for, with your technical system on this week here, you would start looking for bullish trades. And if this was to follow through and go down, you would never get a bullish signal at all. But if you did get a bullish signal, that tells you it's ready to resume the upward trend. So to me, the report helped me because it brought it down to a point now, I want to go bullish, I got a good reward risk ratio. But if this went up and I'm still trying to go bullish with new positions, I got a limited reward because it's already going high. So I actually like the reports that go negative, bring it down to a point it gets it away from the high, so I could get a bullish trade that's giving me a really good reward risk ratio. So this is the good thing that happened. I know a lot of people viewed it to be negative, but I didn't. I looked at it as, okay, I got away from the high, and now I could go in with a bullish trade and target here and get a 3-to-1 reward risk ratio or more to retest that high. So my reward risk is good compared to if I was trading up here.
Yeah, that makes so very, very valid sense. Yeah.
So I like when the reports come out opposite of the major trend because it's a buying opportunity or selling opportunity for me.
That's sharp. So
a little different.
Yeah, a little different because now you're viewing it in line with when the reports actually are corrective, not shifting sentiment. So this report, whatever report happened here, was actually valid for a correction for you to help you create opportunities into the market. So this is like an example on a higher time frame to what I was saying about, when NFP reports come out and then people see, think sentiment is shifting, whereas it's just a correction in line with the market as well.
Yep. And it's just opportunities. Like here, you could just see this is consolidating, but it's still bullish. You see that? Because the overall trend is still bullish, but it's ugly.
Yeah.
But, whenever it comes down, I'm still looking for bullish trades because the overall trend is still bullish. So there's not many opportunities here compared to the pound yen for bullish, but, there's more trades in pound yen right now for me compared to Euro USD because this is still bullish until proven otherwise.
That's really good because you see how you're not the macro trader, but it somehow still blends in. So at the end of the day, it brings us back to the point that there's no separation entirely between, fundamentals and technicals. As a matter of fact, fundamentals, like I said, lead the way for technicals to follow through. So it's important that as a trader, you want to have kind of like a holistic view regardless. Yeah. It wouldn't have to be your major for there's a popular saying that, it's never completed properly, which is a jack of all trade is a master of none, but oftentimes better than a master of one, because then he's been able to taste a lot of things. So you're a jack of all trade, and you're also a master of one. You've mastered your technical analysis. Doesn't mean you put all your attention on just technical analysis. Sometimes you try to, look out the window and say, oh, okay, so it's raining. So if I'm going to step out, I should pick up my umbrella. But some people just think, oh, it's warm inside my house and I don't see any water dripping through my roof, so I'm just going to walk out like that. So that's the key difference. And that leads me into the second to the last part of the session today, which is the trader's responsibility. And I always like to add this segment here in our discussion, because sometimes we forget what our responsibility is supposed to be, as a trader. And we're supposed to trade with the wind, not against it. Sadly, but true is, for someone like you who has spent decades in the market, it's easier for you to manage your emotions when it comes to the market. And rules and systems, they become a person, not with quick implementation, but over time. Just the same way you've gotten used to waking up in the morning and you just have a natural routine. It's not planned. But for someone like you, I know when you wake up in the morning, there's something you do the moment you wake up in the morning. For me, the moment I get up from my bed, the first thing I'm doing is I'm heading to the bathroom. I don't know how, but it's like it's pre-programmed in my head now. Some people, when they wake up, they want to pick up their phone too. The first thing I'm doing is I'm heading to the bathroom. I'm trying to go, ease myself from all the storage overnight. Yeah. It's the same thing that happens it's the same thing that happens with people with systems over time. You've had a system that you've been using, and you've been using the system for over a decade. Now, you don't have to remind yourself. It's just who you've become. So it's why I'm saying it's hard is because we usually tell traders, oh, trade with the trend and all of these things, but we're forgetting the part that a lot of people in the trading game are out to make money. And when making money is the itinerary for the day, you're trying to get it with any way possible. So whether we like it or not, in our last episode, we spoke about something with Kaza when we're talking about survival. So survival has instilled the hustle culture in everyone. And even traders now have the hustle culture. So we know the trend. We're supposed to trade with the trend, but I'm seeing an opportunity here. And we've also had a lot of inspirational, motivational speakers say things like, never miss an opportunity. Take every chance you get. So we're clouded in the head, yeah? So we're on a buy trend and we're seeing options to take a sell before we get to the continuation of the buy trend. It's an opportunity. We're trying to take an opportunity. We're trying to make that money. Even if it's just going to be a couple of, cents on the dollar, at the end of the day, we want to make it. Yeah. So it helps us stray away from the plan. But one of the things that brings us back now is alignment. From where I'm from, yeah, we have an adage, like a popular saying where they say, a dog never runs far away from its home. It always remembers the road back home. So it's more or less like no matter how far you try to go, you're always going to come back home. And so it's important to have a trail, and that's why systems are important, because when you have a system, you have a trail to keep record of. So no matter how far you stray away, you can easily come back and say, oh, I had a system I was supposed to follow. I had rules and regulations I was supposed to follow. I just went astray for a moment, but I'm back. So that's why I always, add this part of the trader's responsibility. So when it comes to trading macros, right, aligning with macro bias is important. Using technicals for timing and avoid fighting strong fundamental flows. So you can see that you can't really take away technicals from fundamentals or fundamentals from technicals. Is no matter how you want to be a fundamental trader, you can't run into the market without understanding what the market is pricing at this particular point in time. So even if I want to trade CPI, I can't just say buy whatever just because of CPI. I need to understand what's the market pricing like. Is there enough liquidity like institutions will look out for? Is there enough liquidity to fill in orders? If there are no liquidity enough to fill in orders, why am I pricing into the market, right? So things like that. And avoiding fighting strong fundamentals. I've seen people try to catch spikes. In fact, I know people that have strategies for catching spikes, and I find it very absurd because who are you? You have no idea, to the direction in which the market would go to, yeah? And they just tell you it's all about the risk game and knowing how to, leverage in those scenarios. But it's not my thing. I personally don't do it. I trade live, but I don't try to catch spikes. When I'm trading live, I try to inform you ahead of, okay, if the reports are positive and negative, this would be an expected reaction from the market. And I believe the reaction to fundamentals actually happen after the release. It could happen in the next, trading cycle. If the release was at the early start of the New York session or before the New York Open, we might actually get the reaction towards the middle of New York, not at the start of New York, or we might see it happen during the Asian session or something of that nature. Yeah. So just anticipate that this could be the next reaction you get, and then you respond accordingly to it. Are there any other things you would want to add for a trader as his responsibility when it comes to, macros?
Okay. You want me to respond?
Yeah. Are there anything you would want to add?
Yeah. So, I mean, just like in life is yin and yang. It's a balance between the other. If you go to one extreme, you're going to go back to the other one, and you're going to be volatile, and you're going to be back and forth. Yeah. You have to be humble to understand everything out there, right? Yeah. And that's the thing where you have to have a balance between technicals and fundamentals in everything you do. That's the way you trade. I'm believe it or not, I'm characterized as the worst trader you could ever think because I'm impatient and greedy, right? But I'm successful today because I understand my weaknesses and I set up my environment to not go to my weaknesses, to go to my strengths. And that's the reason why I'm here today, even though I'm classified as the worst type of trader out there, right? And the thing I want to tell everyone is that I was a retail trader and blew out my account and lost a lot of money. And the reason why is I went to one extreme, which was technicals. I'm an engineer by nature, went down a technical path, I had programming, went down that whole path. And I thought technical analysis was the answer, but it's not. It has to be money management. And the key is that in money management, you have to look at a high reward risk ratio. That means reward versus risk. In order to do that, you have to follow the higher time frames. Go with the wind, not against it. So the goal is to follow the higher time frames, get the reward from the higher time frames, but take the risk from the lower. When you do that, you have the ability to average out 3 to 1 or more on reward risk. And that's the only way you're going to survive. Your technical analysis system has to be built on money management in order for you to survive and be consistent and turn that corner from retail trader to be institutional. And that literally is exactly what you wrote up there, trade with the wind. Because money management is reward risk. That means you have to have a high reward risk. To do that, you have to trade in the direction of the wind. And that's the key. And that a lot of people don't understand. Some people trade against the higher time frame. You're never going to be consistently profitable by doing that. You have to recognize the fundamental picture from the higher weekly time frame, see what that is, and trade in that direction. And you have to be patient to wait for those opportunities to come.
Very
good. That's fine.
That is. I'm looking for. I'm trying to think of the word to use. I don't want to use the word apt, but that's a gem because risk management is where it is for everybody. Yeah, and sad but true is as much as I said something the other day, I was telling my friend and I was like, losses are needed in the market for every trader. And he was like, am I sure that's the right word to use? Needed. I'm like, think of it this way. Every business has to run on expenses. Expenses are needed in a business. And why they're needed is they remind you the reason why you need to make profits. If you're not spending, you won't be reminded why you need to make profits. So losses aren't just failure. It's good we view them as expenses. So by the time you go back to your books and see that you've spent over 30% of your account, it reminds you why you need to be very, very, more intentional about making profits to make sure that your profits would cover up the cost of those expenses. So it depends on the mindset. Yeah. So don't see it as now you're at crossroads and you need to, double your risk. No, it's just trying to let you know that if it could cost you this much to maintain this business, it requires efforts from you and intentionality to also be profitable. That's just how I need them to see it. Yeah. So with that being said, here are 3 takeaways for today's ValeTalks. Okay. Macro trends determine long-term direction, not short-term. Remember this, they determine long-term direction. So if you get the macro report, know it's setting the pace for the month, for the quarter. Okay, that's how you should view it. Yeah. And interest rates and inflation drive capital flow. Like we said, investors want where their money works best for them. Even in terms of a diversified portfolio where they have different asset classes, they have safety, they have risky, and they have income producing. Yeah, they have what do we call that? We have money flow assets, right? In their portfolio. At the end of the day, they want to put their money where it works best for them. And when it comes to the capital market, interest rate is what drives the flow of capital. And technical analysis works best when aligned with fundamentals. So in Manesh's 30 years of trading, regardless of how much he loves technical analysis, he's not blinded to fundamentals at all. So when he tells you he's a technical trader, he's literally trying to tell you he takes his trades based off technical analysis 80% of the time. Because if he sees a strong trend, he understands this is a strong trend and he makes sure he aligns with that. But then when someone tells you, oh, I'm a fundamental trader, they're not trying to tell you they don't use the charts to take their trades. They're trying to tell you they are making their entries based off macro trends. So before they make an entry on the chart, they're trying to make sure that everything fundamentally aligns with why they are taking the trend. So that's just the basic difference. And then you have people like me who so much are in love with sentiment. And and like my friends would say, they say I'm a conspiracy trader. They say I like to forecast the downfall of currency pairs before it happens. But sadly, it's just something I've played around with. Like even trading technical analysis, I learned to trade reversals a lot more than I learned how to trade the trends. Because when I started trading, I was trading synthetic indices. And one of the sweetest things about synthetic indices, you know that after every liquidity sweep, the bears are always heavy. So if you can get in on those bears, you would make as much as you would have stayed in the trend for a longer time. Yeah. So I kind of learned how to catch reversals a lot. I had lots of indicators that would, you look at things like the relative vigor index, the RSIs, the stochastics, and it just kind of help you price into reversals before they happen at very strong key levels. So that is one of the reasons. But I love sentiment. I try to want to play the game on technicals and fundamentals and overall what the market conditions are saying about a particular asset. And I play along with that too as well. I know Manesh should call me a gambler because sometimes you're just playing on sentiments. Eh?
No, I mean, you're actually counter-trend trader. You're going against the natural grain, which is perfectly fine. You just got to be patient than me.
and it puts you at more risk a lot of times. It puts you at
risk, right? It's just being patient, which I'm not patient at all. So that makes it very hard for me to be a counter-trend trader compared to you.
Yeah. Yeah, that's very true. But with that being said, I really appreciate you being on the live today, Manesh. It's always a pleasure.
I enjoy
Like I
it.
said, I always get to learn something from you that takes me back to studying because it's I would say it takes a while for you to learn things every day, except for me that is constantly trying to read more on fundamentals and everything. But learning technicals from you on the chart just takes me back to understand that you never know everything when it comes to trading. There's always something new. There's always a different part to the end goal that you could just, take ideas from to, kind of maybe recalibrate your system at the end of the day. And it's beautiful having you today, Manesh. And I hope the month of March, which is going to end the first quarter, is graceful and profitable for each and every one of us on the call. This is the first time you're on ValeTalks. Please don't forget to like, share, subscribe, turn on post notification so you're alerted on the next time we're going to be having ValeTalks. And until next time, I would see you guys. Don't forget to trade safe, trade smart, and pay attention to the current geopolitical situations in the world. And don't trade, out of context. Make sure you're trading in line with the rules, the plan. Even if you're going to be, suffering some sort of drawdowns, like me personally, if you notice, I've been checking my phone because I'm in drawdowns. But make sure you're trading safe, you're trading smart, and you're trading with Valetax. I'll see you guys next week. Bye, guys.
Thank you. Bye bye. Thanks, Ryan.